All right, this is going to be part one of a two-part series on why I don't like bond index funds. I did a video, not a video, I did a blog post this morning. And remember, if you want to sign up for my blog, aka newsletter, I'll put a link. There's a link in the show notes for the free PDF book of tax bond and retirement accounts. And by clicking on that link, you inherently are signed up for my blog. And you can unsubscribe the minute you want to. It's fine. I don't care. But just be advised, once you sign on to that, you are subscribed. Again, I don't sell you anything. There's nothing like that. But it doesn't matter. So I had a good friend of mine email me. He said, "Hey, Josh, can you?" Well, no, not a good friend. A bunch of people actually emailed me in the last week and a half, 2 weeks, asking for my comparison of the Vanguard Target Retirement Income Fund versus the Vanguard Wellesley Income Fund. And I did a blog post on that, just taking it to task, something I've been wanting to do to get back into my comparison of mutual funds, Vanguard in particularly. And the facts are Wellesley just smoked the Target Retirement Fund since inception. It's not even close. Wellesley just kicked butt and took names. And one of my summations, whatever it is, one of my conclusions, let's use that, a simple word. First, I'm just a caveman. Remember that Saturday Night Live skit? I'm just a caveman. I guess I am a knuckle dragon caveman, right? Because I did very much enjoy the State of the Union address last night. Oh no, caveman Neanderthal. Anyway, so my man, a good friend of mine who's in the business, and he and I see eye to eye for a lot of things. Not eye to eye for a lot of things, but we actually are big boys, and we can manage each other's disagreements without milkshaking them and doxing them and stuff like that. It's amazing how when you're an adult with actually ability to see people for who they are as opposed to the false dichotomy. If he's red, I'm blue. So he texted me back and he showed me from one of his books that he has, because he's a well-read financial planner. And he showed me he took a picture of it that said 90%, 97% of all actively managed funds, bond funds, underperform the S&P 500, not the S&P 500, their S&P bond indices from 2001 to 2016, from 2001 to 2016. 97% of all actively managed longer term bonds underperform their S&P 500 indices. Again, all right, so he's sitting there thinking, isn't that proof of the pudding that bond funds, index bond funds, are actually better, quote unquote, than actively managed bond funds? And I'm telling you, man, people make this mistake all the time, professionals or not. The funny thing on bond funds, it is so doggone simple on how to make sure you get the most return from bond funds, is to make sure the expenses are low. Nothing else matters. Nothing else matters for bond funds except the expenses being low. So when you're throwing in the number that 97% of all actively managed bond funds underperform their indices, the answer for that is, of course they do, because they're charging too high of a fee. No getting around that. But that indicts the high fee bond managers rather than gives props to the index funds. Because do you know what the Vanguard Total Bond Market Index Fund consists of? And I bet most people do not. It consists of about 70 to 75% of government and what's the other word? Government-sponsored entities. All right, so essentially, it's almost 3/4 a government bond fund. Government-sponsored entities, Fannie Mae, Freddie Mac, Ginnie Mae is actually a real live government bond, will be in there, but certainly U.S. Treasuries for the most part. On top of that, the biggest corporate holdings are the most indebted corporations that are out there. I don't know what those are. I literally don't, because I don't pay any mind to the bond index funds, because you're inherently investing in the biggest debtors that are out there, corporations and countries, the U.S. being by far and away the biggest. So if we look back at a bond fund index, and we say, okay, do I want the most heavily indebted companies and countries? All right, I would say no. That inherently tells me a lot more risk there. But even from the corporations who take on debt, and even from the U.S. government takes a lot of debt, that still tells me no, because the government bonds are just nothing. There's nothing there in terms of a yield. relative to the length of maturities. And the reason for that is because, like, I think what we're going into is this a deflationary, low inflationary construct like a Japan. I believe that, absolutely. So while low interest rates are fine, and they'll continue on most likely for government debt, you can squeak out better gains on corporate debt for sure. And if you have an indice that is, why do I keep saying indice? If you have an index that's built on government debt, you're not getting any more than, say, 2 to 2.5%. There's just no two ways around that, my friends. Now, a corporate bond manager can say, I don't want to buy, we'll just say Chevron, Mobil, Exxon, whatever it is, because that's too much debt. Instead, I'm going to buy, Joe Schmo, the freaking rock mover. I'm just looking at some rocks here. And I'm going to buy him or Apple, because Apple doesn't have too much debt. And I think those bonds are more solid. And because they're corporate bonds, they pay a little bit more than government bonds do anyway. So I'm willing to go out into the market and buy some bonds that are a little bit more aggressive than government bonds. But when all said and done, because they don't have significant debt, not likely for these bonds to go kaput, all right? And so because of that, I'm taking a little bit more risk, but I'm getting a lot more yield for the risk. I mean, the difference between, I'm just using Apple there. I have no idea what Apple is, what the yields are. But let's just say Apple's 3, 30-year bond is 2.25, we'll just say. So you're getting literally 75 basis points more. And again, a basis point is 1/100th of a percent. So if you get a yield that's 1%, that means you're getting 100 basis points. So in this case, if you're getting 75 basis points more on the same maturity for an Apple bond as you are for a government bond, in this case, the government bond is paying 2.25, the Apple bond is paying 3, you are getting 33% more interest on the Apple bond than you are for the government bond. Now, the government bond is not going bankrupt. That's true. The Apple bond is most likely not going bankrupt either. So you get 33% more bang for your buck for, I don't think, 33% more risk, frankly. You can make the argument you are, but you're not. So at the end of the day, you're sitting there saying, the index must go into the market for the most indebted stuff that's out there. That is inherently more risky to me. On top of that, that limits their ability to buy various bonds that are out there. Now, the way to ensure you get the best bang for your buck for actively managed funds, come on, bud, is simply look at the expense ratio. The lower the expense ratio, the more you get. That's all there is to it. Do not buy a bond fund with an expense ratio of more than 50 basis points. Again, that'd be 1/2, 1%. I'll show you, I'm getting ready, and I already did this. I use an example. I'll show it to you on my spreadsheet on a USAA bond fund, which I love, the USAA income fund, actively managed, and it smoked the index. I mean, it smoked it. The reason for that is because the portfolio managers have room to roam. And the bond market dwarfs the stock market in terms of the number of opportunities that are out there. So the stock market is limited. In fact, I think the Wilshire 5000 now is only down like 3,500 holdings or constituents. I mean, the market is getting less and less and less, which means it's even harder for actively managed funds to outperform because there's just not that much to choose from anymore. The bond market's not like that at all. The bond market is huge. I mean, there's debt. You can buy debt all over the place. You can buy premium bonds. You can buy discount bonds. You can buy zero coupon bonds. You can buy 100-year bonds. There's bonds, 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 bonds. And to eliminate a bond manager's ability to do that at a relatively reasonable price, say 35 basis points, is, I think, to leave potential on the table. Now, again, a lot of bond fund managers, they charge too much, and thus they're going to eliminate their ability to beat the indices. I get that. That doesn't mean all bond fund managers do. In the simple way, I'm just telling you, man, I haven't even looked at any actively managed bond funds from Vanguard. I don't even know if they have any. I just know at USAA, we have some of the best, as if I still work there, they had some of the best actively managed bond funds you could find. And the reason was that is simply because the bond managers, they're an insurance company. They know what the hell they're doing. An insurance company knows how to manage bonds. Where do you think your premiums go when you're paying your homeowners and auto insurance and your life insurance? It goes to the bond managers to be able to make sure that they have enough money in which to pay out claims should the need arise because of Hurricane Sandy going through or something like that. They know how to manage and mitigate risk. That's what an insurance company does, and they do that by buying bonds. If they don't buy stocks, they probably buy a little bit of real estate, but mostly it's in bonds. They know how to manage debt. That's a fact. And on top of that, their fee structure is low enough where you can still pay a little bit more in expense ratio relative to the indice. Why do I keep saying that? The index. It's like I got this tick, man. Once I start saying the word, I keep saying it, like at the end of the day. I say that all the time. When I watch my own videos, like, dude, I got to figure out a way not to say these ticks I have anymore. If I'm going to shock myself every time I say at the end of the day, zing! All right, so at the end of the day, zing! That's what I'm going to start doing from now on. If I do that enough, no one will watch my channel, and then I know for a fact that I was saying the same words too much. All right, so in the index, the bond index, the facts are if you have a good bond manager who's charging a relatively low expense ratio, there's a good chance that guy will beat the index simply because the index is limited on the constituents for the holdings. Anyway, so I'll show you here in just a second once old stinky butt here drops a deuce. All right, so we'll see you next time. Thanks now.